from Tony. So Stuart, as you know, we have been in full lockdown since the 23rd of March. Do you have any stats or levels of new, with regard to levels of new applications received since full lockdown? And how do these stats compare with January, February, March until the lockdown?
Yeah, very, very hot off the press. Mortgage Strategy have just sent out about 10 minutes ago, funnily enough, an email for the first Q1 figures for the equity release market that showed completions were up 14%, slightly down on Q4 2019, but that's to be expected because Q4 is often the busiest quarter of the year, but 14% up against the same Q1 of 2019. Drawdowns were slightly down to 57% of the market, the rest were lump sum. Any idea what reversions consisted of in the total percentage? 1%, so reversions still tiny. Average loan size was about 109,000, pretty stable. So that's the good news. In answer to the other part of the question about what the market did in the lockdown, it's impossible to say. There's some anecdotal feedback that we're getting from members that it looks to be slightly down but reasonably solid. If you talk to lenders, they give you lots of information, and some of them are saying, oh, we're well up, but, and I put a very heavy caveat on this, that of course what we have no idea of knowing is how many multiple applications are going in. There are car parked applications that are going in to lenders that are, well, they're all now able technically, assuming Aviva come out with some more detail, which they seem reticent to do as of this morning. But there are lenders taking applications on a normal valuation basis that then sit in the so-called car park until full valuations can be done. But the underwriting is easier, and if there's not a necessity to get the case through quickly and get completed, then that might well be best advice. If the second group that then go in are applications to lenders that can process on a desktop or semi-automated valuation to a completion status, we know that there are dual applications going in. There are applications going in almost with no intent of following through to completion. So it's really hard to tell, being honest. So Tony, thank you for the question, but I think that's about as clear as I can get on where we are at the moment. The big firms seem to be holding up. The consumer inquiries are coming in, but there's a lot of consumer holdback at the moment. I saw something from a firm this morning on social media that they're getting a lot of activity, but customers are holding back from doing anything, because of just general sort of health concern attitude, not just specifically for financial services, but they're bunkered down and they don't want to see or speak to anybody to make any decisions. So they're just at the moment doing tentative inquiries, and that seems to feed out with what I'm hearing from other areas, that there's a lot of fact finding going on from consumers. There's a lot of new inquiries coming in. But there's still a big bottleneck for that turning into applications for obvious reasons. So I think the good news here is that if we can keep the consumer activity going, one of the themes that we're keen to migrate, and everybody here can help their little bit on social media, is to get the message out that this sector is open for business fully. We now know that we've got ways through the valuation challenges and the legal process challenges. But talking to a lot of leading advisors on these events, on these, as we're doing now, there's a lot of them that are saying their introducers are drying up because they think that we're closed. So we've got to get that message out and let everybody know that we are open for business. We can process cases from A to Z, and we will hold the introducer's hand through that as well as the consumer's hand. So let's all make sure that on social media we get that message loud and proud that the equity release later life lending sector is here and working.
Okay.
Next
Thank
question.
you, Stu. Tony's also asked the advisors the same type of question with regard to leads coming in as well. So Andy, have you got any thoughts and updates on the fact on leads coming in from your perspective?
From my side of things, leads have really dropped off a cliff, I'll be honest. Very few coming in. I've got 2 reports to write on my desk now, but everything else I've got on the go was really started before lockdown. So my kind of traditional sources, my own website, it's seeing the lowest traffic it's ever seen. There's not a lot coming through. I've had a few inquiries from kind of other brokers, particularly mortgage brokers, but they've been a bit tentative. One this morning was, I want to talk to you about this, Andy, but I don't think I can do it. And lo and behold, no, they couldn't. It was a short-term bridging finance query, really. So from my point of view, inquiries have dropped off a cliff completely. And I'm taking this time really to think not so much about now, but what am I going to do when this is over, or at least we can get a more kind of normal process into place. I suspect that even when we do get out of all this, it will take some time for anything to get back to arguably a normal situation. But to answer your question, yeah, inquiries for me have practically gone, which is concerning. But it's going to be a case of riding most of this out rather than aggressively trying to get new business. I do plan to get in touch with all my introducers, which I haven't done yet, to say, look, we might see a lot more inquiries from the parents and grandparents of people who are perhaps in business or perhaps have lost their job or perhaps financially compromised by this event, and we're quite happy to be talking to them just to see whether or not equity release might be a solution. I was contacted by somebody in the media yesterday to say she had a note through to say now is the time to do equity release, and she wanted a bit of balance on that. And my response was, I think that yes, for some people it may well be appropriate, but these are unusual times, and we don't want to be doing business as a knee jerk until we actually know what the financial effects are going to be on people longer term. We're only 4 or 5 weeks in, and it could well last for another 2, 3, 4 months. So borrowing £50,000 off your mum to bail your business out, only to find out that your business actually fails 5 months down the line, would be a horrendous waste of money and equity. So back to your original question, inquiries have dropped off a lot.
Hels, can I come in there? Yeah, I just want to come in on that because Andy, you raise a very, very valid point. I've been made aware that the regulator is likely to be looking very carefully at the age profile of customers that come in. There is an expectation that the average age will drop, and what they're basically looking for is indications that cases are coming through, as Andy was alluding there to, under duress for short-term need when this is a long-term product sale. And obviously we know a lifetime mortgage is a commitment for a long period of time, and servicing, whether or not servicing the interest or rolling up the interest, the point is it's a long-term commitment product. So fixing short-term financial driven problems, business failures, financial gap filling in the shorter term might be better served with shorter term borrowing products. So it's something that their BDI will be already poring over. So within your advice process, just be aware of that. If that is coming in and you are seeing more inquiries from the 55 to 60 age group, let's just factor that in to make sure the clients aren't being put under. And I guess that leads into a second consideration, and that's emotional duress, capacity, vulnerability, being put under pressure by family members to extract money out of the property. So all of those things we've got to be more aware of than ever before.
Okay, thanks, Stuart. Gary, do you have any thoughts on the question?
Saw quite a few inquiries as lockdown was introduced. The numbers seem to have dropped off like Andy. Most of them were more along the lines of how much could I borrow. It's almost like they're trying to keep all their options open, what options they've got, depending on how this pans out over the next 2, 3, 4, 5, 6 months. I've had a couple of cases whereby the properties don't fit desktops, so they're sat in the car park. I've had a few inquiries that have said, right, thank you very much, Gary, but I don't want to do anything until such time as we've got a better idea of what's on the other side. So slowing up on the inquiries, but still plenty to talk about with those that are talking.
Yeah. Okay. Thank you, Gary.
Okay.
Matt, do you have a thought as well?
Yeah, pretty much exactly the same, really. It's just got slower and slower, and we've sent all our marketing off this last week now as well. We've done a bit of looking on the Google Trends and Google Analytics, and they are just falling and falling and falling. And inquiries for equity release. I spoke to a few guys at Age Partnership as well in their tech department, and they're saying that the inquiries for equity release is just dropping and dropping. Although they're still advertising and everything like that, that people aren't really looking, and the people that are looking are people that are already going through the process, but they're just looking to see if there are going to be any issues. So a lot of people that are inquiring about this are people that have already got an application on the go and just want to know what's happening with their application, really. So we've turned all our marketing off for now, and we're just concentrating on getting the applications through. Hope that helps.
So these sort of comments actually reinforce what I believe, and that is that most advisors have seen a significant drop in inquiries. Stuart, you'll see better than all of us the actual volume of business coming through as a result of those. But I do think an awful lot of advisors are afraid to admit that things are tough, that inquiries have dropped off significantly, the business they're writing has dropped off significantly, and I suspect that a lot of them are, particularly on LinkedIn, kind of grandstanding that everything's okay, no need to panic. I'm not suggesting people do panic, but I do firmly believe that most advisors in this market have seen a significant drop. You have any comment on that, Stuart?
It's a mixed bag, Andy, to be honest. I think if we took an overview picture, you're right. I think the market would be pretending if it wasn't admitting that it's taken a punch like everybody else has. But within that, there's huge variations around the sector. There's some firms that are adapting and changing and still extracting. I guess it's like everything. If the cake is shrinking, you either have less of the cake in the first place and you roll with the market move, or you try and find a way, if there's a way, to increase your percentage of what's left. And that's difficult because you've got to take a business call here, and that's why we've taken this principle of cash flow counts as a sort of strapline on everything we're doing, because we appreciate, I think some people outside our sector often forget that we are remunerated through single premium transactions. So technically any business in this sector, broadly speaking, is 6 to 8 weeks away from bankruptcy. So cash flow is absolutely critical. So we're focusing on helping advisors get their cases through that can get through the changing sort of maze of providers landscape. New inquiries to get through if the client's wanting priority funding to get through as quickly as possible. And all of that ultimately comes down to two core things: the consumer getting the right product at the right time for what they need, and the advisors keeping their cash flow going enough to stay in business. So I think, yeah, it's a mixed bag, but overview overall, it's gone down. How long that lasts for, I don't know, because let's stand back on this and take a look at the demographics. The older consumer base is certainly not going to be any better off for all this situation. They're not going to have better pension fund planning. In fact, it's going to get drastically worse because their pension funds have been decimated with stock market movements in the last sort of 8 to 10 weeks. So they're going to be needing cash more than ever. I think everybody at the moment is just psychologically holding on to make no decisions as long as they can. But there comes a point in time, I suppose, going back full circle here, if we as advisors are struggling with cash flow challenges as business people, like every business sector, consumers are no different, because they also are struggling. And the pensioners, they haven't got jobs, they've got pensions and they've got investments. Well, pensions might be staying where they are from a set point of view, but we all know that 99.9% of pensioners don't feel rich on their pension provision. So therefore it's their other assets and savings, and they're getting hit left, right and centre. So there certainly is a building up demand. The big question for all of us that I really don't know the answer to is, when will that log jam open, and when will those inquiry levels start surging back up again? And I think that is a question which we'd all love the answer to. But I think broadly it's going to be in relation to when the government starts safely removing lockdown restrictions and we get back to whatever normal looks like. It won't be what it used to look like, but whatever it becomes as a status quo that business can function and the economy gets going again. At that point, hopefully, our customer demographic will come back to us.
Yeah, I think we'll see a marked increase in inquiries from the very nature of people struggling, as opposed to all the other traditional reasons that we've been dealing with in the past. I think we'll see a marked increase in those people, the older people that want to help their families, shall we say. So there'll be a much more bank of mum and dad kind of approach to a lot of the inquiries going forward. I know a lot of mortgage lenders are deferring any kind of action on those borrowers who have come to the end of their term. I don't know about the others here, but I've seen quite a few inquiries prior to lockdown from people that are at the end of their interest-only mortgage term and wanting to refinance that. The lenders are deferring any kind of heavy action or forced responses to this. So that's kind of giving people a stay of execution. They're not doing anything at the moment. But I think those two areas are going to be the real growth areas over the next year or two once we do get back to normal. Can I just pick on one thing you did say, Stuart, and that's that some brokers have adapted and are doing things to increase the volume. What sort of things are they doing that they wouldn't normally have been doing?
It's actually quite a good question. The general consensus seems to be, if I could extract out those that are telling me they're doing well, and like you say, I take that with a pinch of salt, because we are as salespeople very good at putting on a brave face when the reality might be different. So I've got to dissect out from there what's truthful and what's flannel. But I think genuinely, and I guess looking at their activity on applications holding up okay must mean that they're still getting consumer inquiries. There's a lot of work around introducers. So if you question how much you speak to your introducers, I think you've got two aspects there. Firstly, let them all know that you're still open for business. Don't assume they'll know, because there's so many mortgage brokers and IFAs who refer that honestly believe our sector is closed. So we need to let them know and maybe nick other people's introducers off them, because if they're not going to let them know, you can. Secondly, the frequency of speaking to introducers, it's a great opportunity whilst we're in this sort of period of quietness to try and extract out and educate our introducers as much as humanly possible. So that seems to be it. You then go up another couple of notches. So TV advertising, I'll talk about TV advertising because I know the stats, but if you move into radio advertising, broadsheet advertising, hard copy advertising in local rags, all of those have plummeted in cost because demand has fallen. So there's two ways of looking at that. You can either save money by spending less, or you can spend the same and get more advertising. And some firms have taken the latter move, some firms have taken the former move. So if that's part of your business profile where you spend money on advertising, all of the newspapers and radio channels and all the other things, you get far more bang for your buck right now. But that could be a cut your costs back or get more for your costs, and every individual business will take the same decisions. Does that help?
Yeah, turn my voice on. Yeah, it does. Yeah, particularly the first point about introducers. I think that's going to form part of my action plan going forward. It's a good comment there. I think you're right. I think they do think we're closed, and we need to get the message out. And surprisingly, I've got time to do that now.
Next question, Helen.
Thanks, Andy. First of all, Tony would just like to, he's contacted me on chat to say he'd like to thank you all for your input in that last question. So thank you very much from Tony. My next question is from Nick Tew. Do you think that providers are providing enough support for advisors during this difficult time? And what other thing could they be doing?
Oh, this is where things get contentious. Yeah, this is like the curate's egg, so to speak. That it's good in parts. Some lenders, I'll be perfectly honest, and I'm not jumping names out specifically. You know who I'm referring to. There were 2 or 3 lenders that right from the beginning jumped all over this. They were all over keeping the options of valuations, getting to desktop valuations quickly. Their comms was very proactive to say, we are going to keep driving this to get a solution as quickly as possible, and they kept the broker market very well in touch. There are other lenders, not mentioning any names, but I think I might have referred to them all earlier on, that I'm incredibly disappointed at. With their corporate size and strength and ability, they have had no excuse to 6 weeks down the road still not be able to communicate a way forward for brokers, and have left brokers in deafening silence. So there are 1 or 2, Nick, I know you're not on the call, but if you're watching this afterwards, who I have been sadly disappointed at. And it's about communication. And I guess now we're moving into phase 2 of what providers need to be doing. It's all very well sending out the mad levels of information. Anybody whose email inbox is not in meltdown at the moment, well, I don't know what planet you're on, but if you're on this planet and in this sector, you're being barraged by not only lenders that are saying, we can now do this, and this is how you do it, and here's our new underwriting criteria, and this is the way forward if you go down route A of wanting a desktop valuation, this is how we go there, and then there's different levels of underwriting, and we're going to do desktops and restrict maximum loans, and we're going to put retentions on, and all of it's brilliant, but trying to actually filter that huge noise into what we as salespeople need when we're serving customers, which is straight answers to straight questions in bullet point format that we can work with, instead of trying to dissect this information. Providers now, I think you'll see a second wave of opportunity for providers, and who will rise to the top and shine will be those that can now clearly explain all of that noise and turn it into really relevant bite-sized pieces of usable information. We're salespeople. We don't like 15 pages of text and a website crammed full of loads and loads of words. What we want is quick, simple answers to the questions that our customers need answered, and we need answered quickly. So I think, Nick, in relevance to the answer, it's been okay with, it's been pretty good with some, okay with others, and really quite disappointing with the third category, and you know who you are if you're watching this.
Okay, thanks, Stuart. The next one was from Andy. What changes to lenders and advisors' way of working due to lockdown do you think might continue once it's lifted? Clearly, meetings with BDMs and advisors can be held with video, but what else? What else do you see happening?
Well, I think you're right. I think what we're doing now, interestingly, as I pointed out yesterday, Zoom was not created 3 weeks ago, 4 weeks ago, 6 weeks ago. Zoom's been around for years. What happens in moments of crisis, and I think the analogy on a call I made yesterday was, it's like the Industrial Revolution. The Industrial Revolution happened at a time of world upheaval. There were wars around the world. There was famine in big chunks of the world. There were huge problems in trying to industrialize transportation systems and everything else. And actually what happened was massive, massive innovation. if you look at World War One, World War Two, and you look at the timings of innovation in medicine, in engineering, in flight, a lot of it was weaponized. And okay, let's be honest, a lot of it might have been motivated to create weaponry through transportation and infrastructure. But the point is that at times of crisis, things change quite rapidly. So will we come out of this and revert back to what we used to do? No. So there will be less face-to-face meetings. There will be more technical-based or technology-based meetings like this. But I think one of the other things which we have to, and I'm not going to steal too much, that we've got a webinar. Heli, when's the advice webinar that Ray and I are holding?
That one is on the 11th, I believe. 11th of May.
So, yeah, I think it is on the 11th. I'm 99% sure it's on the 11th, but details will be going out on that one. And I think there are some big impacts on advice. What this will do is it will drive, we've always been as a sector very proud of the standards of advice that we deliver. And I think what this is starting to do is open questions around how that advice can be more broadly standardized, how we can adopt best practice principles from others. And I think this two-tier sector where we've got those 4 or 5 big firms at the top and then everybody else, I think that will change irreversibly. We'll have far more spread down to the smaller independents. That market growth has been evolving for the last 18 months and will continue. So all of you on this call was representative of the independent broker market. I'm talking about independent businesses, not necessarily independence of advice. I think that will interestingly lead on to, there will be more panel propositions emerge from this. We will see greater transparency from providers and how they interact with us. They will adopt different working practices. So all of which is good. And I think technology really is the simple answer to that. There will be huge amounts of greater technology innovation in this sector. So this call on Zoom is one small example of that. Our technology announcement on Monday next week will be another indication of that. But I think that will just be the first couple of moves on a much broader basis, because I think all of us would agree that the process to do later life lending advice, sourcing, delivery of applications is pretty clunky at the moment. It's not as good as it could be. And if I was giving it a school report as a sector on how we are compared to what we could be using technology, I think we'd get about a 5 out of 10 on our school mark. So there's lots of scope for improvement. And I think this will crystallize a lot of that action happening. And our focus is to make sure all of that technology, firstly, doesn't throw the baby out with the bathwater, that we don't lose sight that this is a people business. Our customers still want us as people, and we drive that, and that will never change. I don't see robo-advice coming into our sector in the foreseeable, but certainly not in my working career, because it is so people-driven, and this generation and the next generation that we'll be dealing with in the next 10 years want us as people involved, holding their hands and guiding them through, and that trust and empathy that we deliver. But we can, at our fingertips, have control of technology that can make that process quicker, slicker, more efficient, and therefore more profitable, because there's some big overheads in this sector that absorb a lot of our income, and that has to change.
I agree with you. Thank you for your answers there. I just asked the question actually when you first announced this meeting, and since then it has become apparent really that lenders, I think, will adopt more of the technology, particularly the Zoom meeting type arrangement. I mean, we've always had Skype, even since I was a lad, so that's a long time ago. But this Zoom thing is a new thing to most people, but it is so effective. I mean, on a meeting yesterday, there were around 80 or 90 people, and I could see everyone had got a camera. They were all there. It's just so sophisticated in that sense, but it is the whites of their eyes kind of thing. And you're quite right, it is a people business. My business has always been I am face-to-face only. I do not hold with telephone advice. But all of a sudden, I'm having to rethink that in terms of, well, what about video advice? Because it does work. I've done 2 cases now on video which have worked. And, so I can rethink going forward. And perhaps I do need a change of model, if you like, because it can be okay.
I'll just come back in on that because that's really interesting. There was a conversation on one of these group calls last week, and the advisor actually said what he's doing is he's changing his pricing and he's offering clients discounts. Even his plan moving forward is to do video advice like you've just referred to. He reduces his fee. So he's actually saying to clients, you've got a choice. I can come out to you, but that means I have to drive for an hour and an hour back, and I use petrol, and that's ineffective. I'd rather give you the benefit if you're happy to do this face-to-face but on a video where I'm not eating your chocolate biscuits and I can charge you less money. And I thought that's a really good proactive indication, as you refer to, looking at what changes will be available moving forward and how we can adapt our charging model, our business models to move with the times. And I think that you're right, that will happen.
Yeah.
Next question.
Thanks, Stu. Tony's just come into this to say, I think that less face-to-face meetings would not be a good thing. It reduces sales and slows down applications. That to go ahead due to postal system. So I hope we will be able to hold as many face-to-face meetings still. So his view is that we do actually go back to the, as many face-to-face as possible, but obviously have that option. And now that we've established this sort of connection with the client base, then they like you said, they do have an option with that. So okay,
I think that's
so
a really
the next
good
question
point.
was from Craig Carrigan.
I was just going to say, Helly, sorry, just a brief final point on that. Yeah, that's one of the downsides of this technology. Very quickly, Tony, go back to you on that. Imagine this is where you should be. Let me just paint a scenario of where we should be on the other side of this crisis. You should be, and I say that quite bluntly, and it's a message to go out to providers. You should be sitting in a customer's house, if that face-to-face delivery is still required, with a computer, with a laptop, and you should be able to talk to that customer, and whilst you're doing so, complete an application, send it electronically, and literally get an underwriting decision or an in-principle decision before you finish the cup of coffee that customer's just served you. That's how it should be, because for God's sake, this is 2020. And yet, despite open banking, despite API functionality, and despite us building a system 3 years ago that was ready and waiting for those providers to plug in, we have yet to get to the point where that is possible. That is obscene, and we need to move with the times. If this sector's serious about growing up, we need, here's an open appeal to anybody watching this with providers, we need you to step up to the plate, and we need you to put those technology abilities in the hands of advisors, because otherwise our overheads, your overheads, customers' time are all not going to be efficiently used. So get it sorted. Thank you.
Thanks. Thank you, Stuart. So yeah, the next question was from Craig Kerrigan. In the horrendous pandemic, what's the thing that made you the most proud?
I think there's a couple of things, to be honest. My team, I have to say, without being completely self-interested here, my team have absolutely stepped up to the plate, and the way they have engineered everything around to support members and the feedback that we've had from members, that makes me incredibly proud. I think on the broader context, the sector, let's be honest here, so despite my comments just now about technology slowdown and dragging the fee, the reality of this is that the wider mortgage market is still in chaos. The buy-to-let market is in chaos. The equity release market is able to function and open for business and have every lender as of this week in a position to be able to process cases through with the input from the council on the legal side That makes me really proud.
Lovely. Okay. Thanks, Stuart. Next one was from Matt. Do you think the Equity Release Council have done enough to support advisors, and given their links to the government, do you think they were slow to react to COVID-19?
Let's do the back end of that question first. Do I think they were slow? Yes, but only in the context that everybody was slow. None of us, and I'm talking about governments, health experts, industry, economy, chancellors of the exchequer and world leaders, nobody really can cover themselves in glory that they were ahead of the curve on this, because it was a pandemic that has been far more deep and far-reaching and damaging than anybody could imagine. So if we now take that back to the council, which was the beginning of the question, I was involved in meetings very early on. I think as soon as it was clear from the country and economy that this was going to be far more serious and we were approaching potential lockdown of movement, the council, I know Jim and Dave Burrows and all the council standards boards and there was a huge amount of engineering going on, because they understood that the legal system, I mean, remember a lot of this, like the witness signing, needing a wet signature, they're legislative requirements outside of the council's remit and control. So they lobbied and fought very hard. So I think it would be totally unfair to say they weren't working flat out. Could they have done more? I don't think they could. I really don't think they could. I'd give them an 8.5 out of 10, certainly, because they were working hard. They were putting in the long hour shifts. There was huge amounts of conference calls, especially with the leading solicitor firms, legal firms, to find a way through that. And I think there's also been a huge amount of work they've done, engagement with provider members to get those wheels moving. Their role in, I suppose, if there's an accusation that they could have done a little bit better, it's around the PR side, to let everybody know our sector is still open. So again, if they're watching this, that's what they can now be focusing on. Back our sector strongly, get us in the media, let everybody know we're open. We're not glorifying this. We're not saying, hey, look, let's make money. That's not the point. How we operate, and every broker I've spoken to in the last few weeks is more focused on their customers than they've ever been before. Do customers need this product? If they need it, how can we provide it? That is not glorification. That is not singing, hey, this market's ready to make loads of money, because it's not. It's ready to help our customers when we need them. So if the council are listening to this, that's the message we as brokers need. We need to get that message out to our introducers. We need to get it out to the consumers that do not, I mean, I'll give you a statistic that hit before this crisis. 25,000 pensioners every year, give or take, depending on the severity. 2015, very severe winter, that figure went up. Last year was quite a mild winter, that figure goes down by a couple of thousand. But fundamentally, 25,000 pensioners die of hypothermia-related illness. They freeze to death. That's the bottom line. They freeze to death. 70% of them are homeowners. So we are still in a world where our customer base do not know that this product is available to solve situations that could ultimately save their lives. And I'm not being melodramatic. That's just one option. Sometimes people are in crisis to that level. So we as an industry have to still focus when we come out of this of how do we better get that message across to the customer so they can decide. We as salespeople stand and fall by how we defend our advice, and is it right at the right time with the right product. That's all sacrosanct. We do that and we will happily be scrutinized by the regulator. But that doesn't help if on the other side of the coin, the 60, 55 plus age group do not know they can raise this money in this way and do not know how safe these products now are. And we only have to listen to the constant noise in the media talking about products that have been obsolete for 20 years in articles they're writing now to know that the media need to get with the program today as well. They need to understand that the products of now are not the products of yesterday. It's like berating car sales now for selling the Model T Ford because the brakes were dodgy. It's like, come on, get with the program. We need to talk about today's products and today's ways and get the customer base to be able to see it. So that's the only thing the council could do more of, but they can always do more of that. So it's not really a criticism. I think they've done really well.
Okay, thank you. Thanks for that. And the next one is from Jonathan McCaffrey. What changes have been made to AIR to support advisors?
Mr. McCaffrey. Oh God, where do I start? I think I'd need a separate webinar. Let's try and précis this. Everything 6 weeks ago in our senior management team discussions began with the 3 simple critical criteria to whatever we were going to do to react to this. Was it in the interest of at the beginning, top priority, was this ultimately in the interest of the consumer? To be in the interest of the consumer, how could it be in the interest of our advisor members and support them in different ways? And the third thing was, did that therefore work commercially and pragmatically with the providers? So those are the 3 things that we sat down and put as the cornerstones. The technology side of things, we've radically upgraded. So on AIR, you can now have the quick quote. You can literally go in, property value, age of client, bang, there's how much they can access and on what terms. So that's nice and simple. We've created the huge reference point, which has involved a huge amount of work with all the providers and to get that on and available. So on the new COVID-19 page, I say new, it's a few weeks old now, but we were the first in the sector to get that up as a full point of reference documentation suite. So every lender is constantly able to update fully all those points of reference. So that's something that took a huge amount of time and continues to do so because these criteria change day by day. We improved our filters, so you can now filter, and again, we were the first off the mark on this to be able to say, if the lender's taking a haircut, like Legal and General, if we take as an example, they take 5% off, we built that immediately into AIR on the filters. So we didn't want brokers to have to do this. We certainly didn't want a situation where members had to sit with a pen and paper like they did 10 years ago, work one set of figures out, then set in another set of figures into the sourcing, then come out and then redirect and re-tinker with those. That was bonkers. So to make sure that AIR was at the leading edge of the technology that they needed, to maintain all of the providers in the later life lending market, and sometimes that gets overlooked. We are the only fully independent sourcing system, and it's whole of market later life lending, not just lifetime mortgages. And we've got all the lifetime mortgage lenders available with arrangements in place. So I think it was a BAU requirement, and I think we took on extra staff at a time when other people were looking at furloughing staff to make sure that that resource was there. All the team did a brilliant job moving to home-based working. So to boost up the ability to answer brokers' queries and worries. And then the final thing that we've launched recently, or we're launching imminently, is the placement and replacement service and the inquiry form that you can send through. So if you've got cases that really you don't know what to do with, or they're sat in a car park with a lender that's going nowhere because they've now, with the new criteria, fallen between the cracks, the team can help you place that, and there's a document that you can access to ping it through on email. The online chat facility is there. So there's a whole raft of things, but to make sure that fundamentally the AIR Club and AIR membership is looked after. And I guess the other wraparound to that is cash flow counts. So we suspended membership payments of the Academy, and the other organisation that's in the market in that world hasn't done that as yet. I hope they might take that message that it should be done because it's the right thing to do. And we're announcing something on Monday which will have a free trial option, again, because cash flow counts. So anything that we can do to help with money. And the final thing is our reward scheme. We've changed that around, or in the process of changing that around, and we're bringing in extra points now for applications. So even if they're just car park, they're still going to earn you those points. Those points can be cashed in. So again, it's cash flow, cash flow, cash flow, because we understand how critical that is. And our members, if we stand shoulder to shoulder with them now, they hopefully will stand shoulder to shoulder with us in 3 months, 6 months' time. This is partnership, 50-50. We do, you do, you do, we do. So that's how it is.
Okay, thank you, Stu. Just one of the other questions that has come in as well. With there being 3 clubs now in the market, will this change air?
No, and I think it's really good that we've now got those 3 clubs in the sector. Competition always adds things, but I'll put out an appeal here, and I think it's a fair one. Competition should bring new things. If all it does is a variation of the same thing, then no, it's not useful. So the appeal and what happens when you get competition generally is that you get dynamics, you get innovation, you get things moving and changing. So will it change air? It will change air in as much that we will, I guess it's always easy. It's like in football. Everybody wanted to shoot at, if you go back to the 90s, everybody who supported any club except for Manchester United always used to be critical of Man United because they were hugely successful. They won everything. So we cannot for 1 second sit back and take anything for granted. We might be the biggest, but that's not a right. None of our members are tied to us. So what it will do by having 3 clubs as opposed to 2 clubs, or even, I guess, in the old days when it was just us, it spurs us to keep looking at what we do for members. Can we do it better? And our membership feedback with 6,000 odd members keeps us at the forefront, but only if we listen. It's no good having 6,000 members and then we ignore them and just do what we want to do. If it's going to change air, it's because our members want us to change air. So will it corporately change us? No. Will it give more focus on making sure there's better resource at the hands of the advisors? Yes, because that's what competition does. So that's why I think it's a good thing.
Okay, lovely. Thank you. Well, that's all the questions we've got for today. Just to go around, has anyone got any questions, any thoughts they'd like to bring to today's meeting? Andy, we'll start with you first.
Sorry, I couldn't unmute. No, I've got no further questions. I appreciate you doing this, Stuart. I think this is valuable. Okay. I have to say I'm surprised at how few people attended, because this is, I think, quite valuable to advisors. They'll be wise to get on board with any more that you do in the future.
We've done a long ongoing series of these, Andy. So the plan is that we're going to do these every single week now. So we've already had a few. These are a rolling series, but feel free to come back in, register for subsequent ones. It's not a one visit thing. And I quite like sort of doing these, and it's intentional to do lots of them with smaller numbers because it's more interactive.
My apologies. Okay.
Yeah. 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 Thank you for that, Andy. Gary, do you have anything you want to bring?
Is that better now? Can you hear me now?
Yeah, we can hear you now, Gary.
No extra questions. A bit like Andy, I was surprised that there aren't more of us in on this meeting. I think it's been very useful, probably the most useful one that I've been to over the last 6 weeks or so. What I would say is the web chat facility you've got, the girls you've got manning that are excellent. And if anybody else doesn't use it, I'd highly recommend it for those quick answers to, well, to me, are awkward questions. Thank you.
Thanks for that, Gary. Thank you. Matt?
Yeah, no, just thanks for doing it. Kind of on the flip side, I've been involved in quite a lot of these Zoom conferences, and actually touch on Stuart's point about Zoom not being around for the last 3 months. I wish I'd had shares in Zoom 3 months ago. I really do, but that's a side issue. No, I've been on large numbers where there's been 50, 60, 70, 80 people. And then I've been on the smaller ones. I actually like these smaller ones because it's more interactive, and it's nice to hear what other advisors have to say about things. And you know, sometimes when you are going through a sticky patch, it's nice to hear that other people are struggling as well, in the nicest sense of that. Meaning it's not just you, it's the market that's down. So yeah, no, I've enjoyed it. It's been good. So yeah, thanks for that.
Okay, thank you, Matt. Thanks for that. Tony's also mentioned he just wants to say thanks very much for Stuart and I for putting this on. So yeah, we're more than happy to be here and support you guys with anything, be that through this medium or by online chat feature, telephone or email. We're here for you, because that's how we survive, is looking after you guys.
Yeah, I think I'd echo that. Thanks for everybody for attending, and the comments about sort of small numbers and things are sort of taken on board, and I think they're sort of a good mix, trying to get the right balance of numbers. But what I would ask is really sort of share these comments and things. Please sort of let everybody on LinkedIn know that these are running now on a weekly basis, and you've now seen them. So share your thoughts. A couple of previous attendees have done that, which goes down really well. So thank you all for coming out, and good luck for the next few weeks. If there's anything the team can do, please give us a shout. We are here to help.
Thanks. And the net is actually on the 13th of May with Stuart and Ray McCarthy. So we look forward and hopefully see you then. All right. Thank you, everybody.
Thanks, Alan.